Fear is back on Wall Street as volatility bets tied to the VIX hit a 6-year high earlier this week. And our next guest writes in the Wall Street Journal that traders are positioning for a prolonged stretch of volatility. Gunjan Banerji is the lead writer for the Wall Street Journal's live markets coverage, as well as a CNBC contributor. Gunjan, great to have you with us.
Thanks, Melissa.
6-year high levels seem like a big deal, but in particular, if you think about what was going on 6 years ago, because February 2018 was a huge volatility event.
Crazy. I mean, that was Volmageddon, right? We saw a huge explosion in volatility at the time. S&P 500 lost around 10%, a very short time frame. What traders said was alarming about this time around was that we're only 3 to 4% off the highs in the S&P 500, and yet we're seeing this stampede into VIX bets, into volatility trades, and wagers that this recent turbulence that we've seen over the past 2 weeks will continue. And this is really the first sign of fear that we're seeing in the market after really going in a straight line up for months now.
I mean, the idea that we had actually gone on Friday, what did we get to, like 20 or 19? I mean, really, historically, that's not very high. But in a world where the VIX had been regularly at 15 or 16 or 14 or even lower, that seems like a huge spike. What are traders saying in terms of how high volatility can get and eventually how that will impact the markets? Because volatility is just a bet that it's up and down, right? It's not necessarily that stocks will go down.
That's true, Melissa. But what's remarkable is that the past few weeks or months, we'd actually seen bets on upside volatility, bets that things would get volatile, but NVIDIA shares would keep skyrocketing, or the S&P 500 would get more volatile in terms of big jumps up. People were afraid of missing out on those rallies to the upside. And now we're seeing downside hedging. We're seeing actual hedging, the types of trades that would profit if the stock market did fall. Think of these as insurance-like contracts. You know, the demand for stock insurance increased significantly over the past 2 weeks. And this is a remarkable shift from, you know, the roses and sunshine that we saw the prior months. And I think a lot of it comes down to inflation, geopolitics, and of course the path of treasury yields, which I think are finally spooking the market after, you know, the stock market being pretty resilient in the face of rising yields recently.
So when you're talking about bets on volatility in terms of, hedging, are you also seeing commensurate trades on the option side for SPY and for NASDAQ 100 in terms of hedging?
You know what's interesting? A lot of traders have been telling me this is concentrated in the VIX complex.
Oh.
And that's interesting because, as you pointed out, we have seen the VIX rise to some of the highest levels since October, November. And while there has been a pickup on the S&P 500 side, that's what the higher VIX is reflecting. People are placing call options bets tied to the VIX itself. And that's really a true volatility bet. That's a bet that things could kind of get haywire. And we're seeing that in the futures market as well, where pricing indicates that people are expecting more volatility over the next month or two than, say, in the next 3 months. So there is this near-term fear that this whole complex is reflecting right now.
What do you think are the fundamental reasons for it being a 2 to 3 month bet? What events on the horizon? Is it just the uncertainty about interest rates at this point, and probably increased uncertainty now that Fed Chair Powell said what he said yesterday in terms of keeping rates where they are for longer?
Right. So, Melissa, what I did hear was that a lot of this activity started picking up Friday, heading into the weekend. And that was a lot of the Yes, it was the geopolitical fears where people were saying, we don't know what's going to happen here. And that led to that rush into VIX options bets. It continued this week, and it's been incredibly elevated, especially when you think about the calm that we saw previously.
Do you think traders are thinking in their head that we will see that 10% decline, the same that we saw during Volmageddon?
Look, I think we're 3 to 4% off now. And what traders have been telling me was it's almost like people woke up and realized, hey, the stock market doesn't go down. It can go down. It turns out we can have a little bit of volatility. And I think people forgot that. And I think we could see more of that today. We have a treasury auction at 1 p.m. These have become like the hottest, things to watch on Wall Street. They used to be really sleepy, but they're causing a lot of volatility. We saw that last week after the inflation data, where the 10-year recorded the biggest one-day jump since 2022 after kind of an ugly auction, some ugly inflation data, and I think we need to stay tuned for that today.
Yeah, a down 10% actually lines up on the technical side of things for the S&P 500, so that's interesting that they're targeting that or thinking about that in terms of the time frame. And on the technical side, that's where we see the S&P getting down to the bottom channel. So that's an interesting level.